Okay, so for this video, I wanted to talk about Form 1040 filing requirements based on income threshold. So the question posed is, if my W-2 is only $10,000 in income, do I still need to file a tax return? And the answer is it depends, right? So let's get into some of the rules. Generally, I always recommend filing a federal income tax return if you're a U.S. individual person, right? Even if you have little to no income and you might not even owe any taxes. Here's why. So three big reasons I've got listed here. First is the statute of limitations. So under the statute of limitations, the IRS generally has 3 years from the day you file the return to basically examine it, audit it, try to challenge you on the position. Now, what people don't know here is if you never file the return, the statute of limitations for that year never starts. So if, let's say, 2020, you decide not to file a return, 10 years, 15 years could go by and the IRS could come back and look at 2020 and say, hey, you had some income here you should have filed. Let's go ahead and get that sorted. We'll charge you taxes, interest, penalties, the whole works. Don't be in that position, right? So that's why I always recommend filing. Even if you have little to no income, maybe don't owe any tax, just because you get that statute of limitations clock to start ticking. The second piece is filing a return ensures that no one else can file on your behalf. And so what do I mean by that? Well, there's been a recent wave of identity thieves taking individuals' names, addresses, social security numbers, and they're filing 1040s, fake 1040s, to claim credits and get your tax refunds, okay? This is also a disaster, obviously, because people are filing fake and fraudulent returns on your behalf and they're taking your money. By you filing a return before they can, you're effectively blocking them out, right? So the IRS will only accept one e-filed return for the most part. So if you go ahead and file and then somebody gets your identity later and tries to file a return for the same year to take your credits or your tax refunds, it's going to get rejected, right? So that's one additional step you can take to make sure that you're protecting yourself, your privacy, and your tax refunds. And then lastly, you might need a return for non-tax related purposes, right? The most common one is when you go to a bank to apply for financing for your home. Okay, so the bank always asks for, give us the last, let's say, 3 years of returns, 4 years of returns. It's better if you have a return that was filed, and even if it has little to no income on it, rather than just saying, oh, well, I don't have a return for that year because I only made X number of dollars, decided not to file. That might be true, and it might have been okay, but you're much better off just saying, yep, here's 3 years, here's 4 years, whatever you want. Have a look at it. Let me know if you have any questions, okay? So let's talk about some of the filing thresholds. Well, a U.S. taxpayer needs to file if they have earned income, so employee wages, and any kind of investment income that might exceed the standard deduction for that year. Now, in 2020, the standard tax deduction was $12,400 for a single filing taxpayer. So if you had income over that amount, you should be filing a return. So let's look at an example here. We have John. He's single. He earns a W-2 income that has box 1 wages of $12,500, and on his W-2 he had federal income tax withheld of $500. So John prepares his 1040. He reports the income. He takes his standard deduction, $12,400. So he has taxable income of $100. Now the tax owed on $100 is only $11, right? Because John had $500 in withholding, he's going to get a refund, right? $500 in tax withheld, his total liability was only $11, so he gets a refund of $489. Now, if John decided to not file his return, this money would be kept by the IRS, right? They're not going to just cut you a check for $489. You need to file to reclaim this money. So again, another reason to add to the list, even if you might not have to pay any more tax when you file your 1040, you might very much get a refund from the IRS, which you're not going to get unless you actually file. Okay, so let's look at the next example here for self-employed persons. Okay, so a self-employed person, the thresholds are a little different. You should be filing a 1040 if you had any self-employed income for the year. Frankly, any kind of self-employed income, because the IRS requires that you report gross income from any source derived, and then with self-employed earnings, you're allowed to take deductions against that income in connection with your business. So let's look at an example here. Adam is a single taxpayer. He's self-employed as a consultant. He opened a single-member LLC that's a disregarded entity for federal tax purposes. That's what he conducts his business through. And so he needs to do a Schedule C for his business that goes along with his 1040. His business generated $2,000 in gross income, and he had $500 worth of expenses. So his net profit for the business is $1,500. Now, the $1,500 in net income is exceeded by the standard deduction, right? So he gets a standard deduction of $12,400, which far surpasses his net income of $1,500. So he's not going to owe any federal income taxes when he files his return. However, because he's self-employed, he's also subject to self-employment taxes on this $1,500. So that's where he's going to owe some tax. $1,500 in self-employment income results in self-employed taxes of $212. So Adam's going to have to pay $212 in taxes to the IRS, and those are attributed to the self-employed taxes only. He doesn't owe any additional federal income tax because his net income did not exceed that standard deduction. Okay? So let's talk about some special circumstances where you just want to file no matter what. If you're a taxpayer and you have an interest in a business, or especially if you have any ownership over any foreign assets, so those are foreign bank accounts, if you've got stock in a foreign corporation, a trust, partnerships, foreign disregarded entities, other foreign financial assets, all of these need to be disclosed on a tax return, even if you're not generating any income from them. And failing to report these on a tax return can result in substantial penalties, right? So, for example, foreign bank accounts, that could be a foreign bank account. It's just a checking account. It's earning no interest. Let's say you've got 15 grand in there. Under the FBAR filing rules, if you fail to report that on an FBAR, so you have to check the box on Schedule B of your Form 1040 and file an FBAR with FinCEN, you could be looking at a $10,000 penalty by omitting that. And that will apply even if it's an account that generates no income. So not even a non-interest bearing account is going to have these kind of problems. Yeah, so the international return disclosures carry some heavy penalties, right? Failing to disclose foreign corporations on a 5471 or an 8621 for a PFIC, $10,000 penalty minimum. Same thing with partnerships, 8865s, $10,000 minimum. And then for other foreign financial assets, 8938s disclosures carry some substantial penalties as well. So really be careful to assess your overall tax profile. It's not just how much income you have, but it's also what kind of assets you have, where are you earning passive income. These are all elements you should consider in order to decide, when you should be filing a return. But again, I go back to point one at the top. Always file, right? Don't leave any open years because, it's generally always to your benefit to go ahead and file a return, even where you don't owe any tax or even when you might not have any of these international disclosures. Okay, so thank you for watching. I appreciate you sticking through to the end. If you have any questions, please leave me a comment below, and I look forward to seeing you again soon. Thank you.